So bank stocks stumbled this week after S&P Global downgraded the credit ratings of several U.S. banks.
This includes some of the nation's largest lenders. The credit agency pointed to tough operating conditions that are straining the banking industry. The move comes just weeks after Moody's cut the credit ratings of 10 banks.
The credit agency said, quote, profitability will likely worsen further in 2024, but we still expect most rated banks to generate a healthy level of capital through earnings retention.
Carleton English joins us now. She's a reporter for the financial publication Barron's. Carleton, welcome. So put this in perspective. Is this a reason to worry, especially for those who have money with these banks?
Yeah, and I think thank you for having me. And I think you highlight the point where there's the difference between the people who are investing in the banks and then the people who have their savings accounts in the banks. So if you have your savings in the banks, I think you can feel pretty safe about your savings being there. Obviously, we went through upheaval in March. The Federal Reserve and other regulators took drastic steps to try to ensure that that won't happen to many other banks. And then since then, we have actually seen that deposit flows have stabilized. People are keeping their money in the banks. You're not having those bank runs that cause problems. Now, on the flip side, if you are an investor in the banks, bank stocks are still safe, but it might not be the best spot to put your money right now. As S&P noted, there are concerns about profitability. As an investor, if you're looking a year ahead, do you want to put your money in a bank stock or a company like Nvidia, which just seems to see its stock soaring with little interruption?
I'm wondering, Carleton, if you can talk to us a little bit more about what's behind these downgrades. How much of this is the balance sheets of these banks with mortgages that are at 3%, 2.5%, with now mortgage rates being so much higher?
Yeah, so what's going on with the bank balance sheets? Obviously, the Federal Reserve has raised interest rates at probably one of the fastest clips in history. So that means that a lot of the assets on the bank's balance sheets aren't worth as much as they were when they were issued. Again, as long as those assets just sit and run off naturally on the balance sheet, that should not be a problem for the banks. What we saw in March was the assets were sitting there. You had a lot of deposit flight because these banks were in very, Silicon Valley Bank and Signature Bank were in very concentrated industries where, say, you have one tech investor that pulls their money out at once, all of them are going to because they're in a similar industry. They're facing similar problems. The banks that we are seeing now, the ones that did get some of these downgrades, they have a much more diversified client base. It is going to be a challenging time for them, absolutely. But there's a difference between challenging and catastrophic.
So you mentioned the Federal Reserve. What will be the effect or could be the effect if the Fed continues to raise interest rates then?
Yeah, so when the Fed raises rates, when they first start doing it, banks love it because they can charge more on mortgages and other loans that people have. They're very slow to raise what they pay out to us in deposits. Now, when rates go up as quickly as they have, savers like you and I say, hey, wait a second, if I can put money in, a treasury bill and get 5%, how come my bank is giving me 0% for my savings? So what you're seeing happening with banks now is that spread that they get on what they earn on the loans that they pay out and then the interest that they pay out to people like you and I on deposits is narrowing. Now, for the banks, that just means higher funding costs, higher costs. But again, the overall stability of the sector is fine. In fact, even when S&P downgraded these banks, which is reasonable in light of the recent situation, the outlook on them remains stable, suggesting that they're not going to have another downgrade.
Carleton, one last question for you. I really appreciate that you made that distinction between investors and customers for these banks and that customers' deposits are all FDIC insured. But are they now facing a confidence problem with both groups?
Yes, absolutely. One of the beneficiaries of what happened over the last few months was the larger banks, right? They had more diversified revenue sources. But I think what we've seen, especially when we got earnings from all banks in July and into early August, was that deposit flow, the people pulling their money out, that has thankfully slowed down. So banks are looking a little more stable. But again, it's a challenging time. And for investors, you're looking at stocks that maybe pay great dividends, but you're not going to expect those stocks to take off anytime soon. So it is a challenging space to be in, but again, not too bad, I should say.
All right, Carleton English, thank you so much for breaking that all down for us. We appreciate it.
Absolutely. Thank you and have a great weekend.